But, well, the first question is not very pleasant. The third quarter is at an end now, and from what you have heard and seen, does it look like it is an improvement over the second quarter in any way?
I mean, possibly. We might get some improvement, at least on a seasonally adjusted momentum basis, but that's very difficult to do with the kind of quality of data that we have. So we might get some momentum increase, at least given with some, green shoots popping up here and there. But I think, nothing to write home about. And I think this year we'll probably struggle to get 5, and hopefully next year will be slightly higher to maybe around 5.5. So that's basically what we are looking at for 2019, fiscal year 20 and fiscal year 21. So no, things are not looking very good on the growth front.
No, but 5.5 next year is a little intriguing. Would not the rate cuts and other activity, hopefully that will come in the budget, lead to something better? And there is also a liquidity gush from global central banks, which is providing capital to a lot of Indian companies, or some Indian companies. You don't think all this adds up to much? I mean, only 0.5% better than this year, next year?
Let's go through with the arithmetic. So we have what, 135 basis points of rate cut. How much of that has actually gone into lending rate? Hardly anything has gone into lending rate. So yes, you have a gush of liquidity sitting around, but nobody is being able to access that liquidity. Instead, Indian corporates are going abroad and bringing in ECB money, and the RBI is intervening both in the spot market and in the forward market and raising hedging costs. So we are going, most of the corporates most likely are even going unhedged into the foreign market to raise money. So yes, there is liquidity. Yes, there has been policy rate cut, but none of that has actually transmitted into credit growth. None of that have actually been picked up by Indian domestics. So unless that happens, it's very difficult to say that just because you have 135 basis points of rate cut, that will get translated into X percentage points of growth.
There is a 200 basis point fall in CPs of AAA companies and even AA. If you take from November onwards.
Sure.
So there has been some transmission. I agree that, for outstanding loans, it has not been very good. But some bond market yields have fallen substantially.
Right, and the amount, look, I mean, let's set aside the government bond market. I'm sure you can ask me questions on that, but let's stick to the corporate bond market. Yes, there has been some transmission. And I'm guessing that transmission, over 3-4 quarters will get passed on to somewhat higher activity, somewhat higher working capital, etc. And, don't really see that, it could be more than 0.5 percentage point. You have a very, very large fiscal impulse already in the economy. Most likely, we are going to hit 3.8 this budget. They're going to take full advantage of the 0.5 space that the Fiscal Responsibility Act provides them. Next year, they will be consolidating. It's almost, let's say they consolidate about 0.5 percentage point. You're taking out 0.5 percentage point of stimulus and you're only depending upon what the impact of, 135 basis points, how I'm not even sure a full amount has been translated into corporate bond market to sustain the economy. I mean, that's a very, very hard call to say all of this is going to give you more than 0.5 percentage point of pickup.
Absolutely. Jahangir, hi, good morning. Since you use the word stimulus, I want to ask you what your expectation is, because from a market standpoint, there's now a huge clamor for an income tax relief after the corporate tax cut came through in the budget. But there are reports indicating that instead of an income tax relief, there may be some spending stimulus as well, more funds allocated to infrastructure, etc. Realistically, what are you expecting from the budget this time in terms of a stimulus?
Look, I mean, this isn't rocket science, right? I mean, if you believe that there is a demand deficiency, you do things to stimulate demand. If you think that the demand deficiency is right now and you need urgently to stimulate demand, then you take actions where you do not have to worry about designing new infrastructure project spending. You don't have to wait for whether or not the corporates are actually going to use the corporate tax cut, or whether households will actually use the space provided to them with income tax cut. You essentially go and cut GST. You slash GST by the amount of whatever was the space that, whatever the space that they use for corporate tax cut. You make it temporary. Let's say you make it for 1 to 2 years, so that people have to spend that money now to avail of the 20–25% decline in prices. And that has been something that we've been using, not just us. We used it in 2008–9 very effectively.
Yeah.
Many other countries, including China, continuously use that method. Rather than we are using things that where the impact on growth depends entirely on how corporates are going to behave and how households are going to behave in a world that is very, very uncertain. That's not the right way to stimulate an economy where the stimulus is required now.
Yeah, I take your point, though, of course, I guess we overstayed our welcome in 2008–9. The excise cuts went all the way up to 2011, and we lived to regret it.
That's right.
But Jahangir, what is
absolutely, yes.
What is the global backdrop in which all this is happening? All the central banks have turned on their taps.
No.
Should we expect something better, kinder from the global ambience?
Sure. So, things don't look very good right now. I mean, if you look at activity data, regardless of where you look, except for Asia, China and the North Asians that are tied to that supply chain, more or less, activity data everywhere else looking, terrible, particularly in the manufacturing IP side. And there is a concern that this is already spread into consumer. But if you look at forward survey data, I think all of them point to a reasonable pickup taking place, perhaps starting from the second quarter of 2020 and then going into the rest of 2020. So our sense is that you are probably going to see a much better turnout through the course of 2020 than at present. If you compare the average of 2019 to the average of 2020, you're not going to see much pickup. But if you compare what's happened to the fourth quarter of this year or the first quarter of next year, where we believe the global economy is going to bottom out, but from there is a reasonably large turnaround, both in the US as well as in Euro area, and of course in emerging market countries as well. So we are hopeful that there will be a turnaround. And again, we don't think any of the G3 central banks are going to do anything except for keeping things on a very, very easy stance. So it is a reasonably good environment to be in, perhaps starting from 2020 second quarter onwards.
What is your own view on the RBI's Operation Twist, 2 rounds of it that have taken place so far? Do you see interest rates come down further? And what is the impact that all of this would have on the money markets in the medium term?
I knew you were going to ask me that question. Look, I mean, the idea that, look, I mean, the 10-year sold off because the RBI went against market views and did not cut. That's when the 10-year sold off. Now the RBI is trying to make up for that increase in 10-year rates by doing this thing called Operation Twist. You usually do Operation Twist, or other countries have done Operation Twist, when you do not have any more space left in standard interest rate policy. You're hitting the zero bound, you don't really have much space. You do Operation Twist with QE and yield curve control that BOJ had, etc. You don't really have to do Operation Twist when your short end is at 5.5. Now, I understand that this may be related to end-year balance sheet optics, but generally it does not look, the optics of this operation doesn't look good. On Friday you have an auction and the same bond is bought. I'm not saying in huge quantity, but the same bond is being bought on Monday, and they've already done that twice. And again, you're giving a signal that those different objectives of the government, of the RBI, keeping inflation down, keeping interest rates stable, keeping exchange rates stable, and targeting the 10-year rate, which has always been the problem. I mean, you and I, Lata, have been talking about this for 10 years.
Yeah.
That's always been the problem of having these multiple objectives. Once again, is showing up where the RBI is doing things which is very, very confusing to the market. I mean, what exactly is the RBI targeting now? Is it inflation? Is it FX? Or is it the 10-year rate?
Yes, sir. We take on board your old report where you said RBI shall not be the merchant banker of the government. That point is taken. But, you know, we swung on one side. Remember when the government was actually announced a market borrowing extra program on the 28th December, I think 2016 or 17, and punished the banks with MTM losses. Right. We are making up for past sins. Okay, it's a cosmetic change. I take your point. But just to finish, what you were telling Sonia that you do a twist when you believe that you don't have space to cut rates. You think the RBI has space?
Yes, I mean, the RBI, the headline numbers are going to look terrible. And we know why. Food inflation has picked up. Food inflation most likely will keep picking up at least till February. It is going to look terrible. But we do know that core inflation is not only stable, core inflation is actually in, almost languishing. And I think that the RBI should have looked through this increase in headline inflation and should have said, look, and we understand this, over the next 6-9 months, inflation is going to come down. It's in their forecast, and as a result, we will continue cutting rates.